a quote from your book that I really like. You say that the stock market is the greatest wealth creation machine of all time. And I couldn't agree more.
If you look back at any chart that shows the long-term history of the Dow Jones Industrial Average, or better yet, the S&P 500, the undeniable long-term trend could not be clearer. Up and to the right. It is not a straight line. It is a rocky road. A whole bunch of volatility happens along the way. And the stock market is the simplest way for ordinary people with ordinary incomes to grow their wealth exponentially over time and retire as a multimillionaire. It's never been easier than it is today to harness the power, the long-term wealth creation potential of the stock market. Now, there are ways that you can grow your wealth faster, but if you're looking for easy, no research, compounding growth, to me, there's no better vehicle than the stock market.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money, how to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, investor, and a founding partner of Sicard Associates, a boutique investment firm founded in New York City. Join me on this quest to unearth the wisdom of the ages. Welcome, everyone. I'm so glad you're tuning into my podcast. For your convenience, the show is available on a multitude of platforms, including Spotify, Apple, Google, Audible, and many more. If you want to keep up with all new episodes, and there's so many more in the queue, make sure you subscribe and please do share it with friends and family. Review it and rate it if you can. Every little gesture matters, and I thank you for it. If you'd like to know more about me, or if you're interested in getting in touch, simply Google my name and it will lead you straight to my website. There's a contact form there, or check notes to this episode for links. I love hearing how you listen to my podcast on your walks, hikes, alone times, drives, trips, and more. I trust that my guests and I are a wonderful company on those adventures. I also enjoy reading how some of you are rehearsing and answering some questions that I ask my guests. I love hearing that. If you're new to the show, please scroll down and check out all the amazing guests I've had over the last few months. If you are serious about investing, money wisdom, wealth, and living a better life, you'll find plenty of episodes with some incredible ideas. For those who enjoy reading thoughtful pieces, I regularly write articles on Substack, which I'm sure you'd find insightful. Find me there and follow me as well. Finally, I'd like to mention my latest book, Crisis Investing. It's a collection of 100 essays that I penned for our clients during the tumultuous times of the global COVID pandemic. These essays are both timely and timeless, providing a unique perspective on navigating through crises. They were never meant to be published, but here they are available to you. Please find the book on Amazon. The book has already received considerable recognition and much love, ranking among the top releases on Amazon in its initial weeks. Thank you for your support and for being a part of my listener community. Now, without further ado, let's dive into today's episode. I'm really excited to present my today's guest, Brian Feroldi. Brian is a financial educator, YouTuber, and author. He has been intensely interested in money, personal finance, and investing ever since he graduated from college. If you walk away with one big idea from this conversation, let it be this quote from Brian's book: "The stock market is the greatest wealth creation machine of all time." Brian started investing in 2004. In the beginning, he had no idea what he was doing and got his teeth kicked in. His returns improved dramatically as his experience and knowledge about the stock market grew. Brian's career mission statement is to demystify the stock market. He loves to help other people do better with their investments. He has written over 3,000 articles on stocks, investing, and personal finance for the Motley Fool. In 2022, Brian published his best-selling book, Why Does the Stock Market Go Up? It was written to explain how the stock market works in plain English. Brian lives in New England with his wife and 3 kids. We talked about childhood and career path, stock market as a wealth creation machine, money as a taboo topic, value and price in the stock market, determining the right purchase price, pumpkin spice latte and salted caramel frappuccino, and daily price moves in the stock market, why the stock market always recovers, investing during economic downturns, the importance of saving, and how investing isn't just for the affluent. Stay tuned until the end if you want to hear when Brian reveals the biggest edge that investors have over Wall Street. Please help me welcome one and only Brian Feroldi. Hi, hello, Brian. How are you? Nice to see you.
Thank you for having me. It's great to be here.
As you know, I'm a big fan. I read your book, Why Does the Stock Market Go Up? Everything you should have been taught about investing in school but weren't. And I loved it. I highlighted every other sentence in the book, so I have a lot of questions, as you can tell. But I like to start those conversations from the beginning. And I'm curious to ask you about your childhood and upbringing. And I'm very intrigued how that time you think influenced your particular curiosity in investing and the career path that you chose.
Sure. So I was born and raised in a middle-class family in Rhode Island, which is where I still live to this day. I had a very fortunate childhood. Both my parents worked for a living. We had a very nice lifestyle in a nice suburban house. Money was never something that my parents fought over, and both of them were naturally frugal people. They never sat us down and really taught us lessons about money through language, but they did themselves live a frugal lifestyle, and they would occasionally drop hints to us kids, like, if we wanted to, we could drive a fancy car, but we don't want to. It costs too much money. So I had a very fortunate upbringing from that perspective. And for whatever reason, I was just born to be a natural saver. I think some people are born natural spenders, others are born natural savers. I was definitely born a natural saver. As soon as I started earning money, I essentially had always set aside at least a small portion of it to pay for indulgences. And I've always gotten pleasure from the idea of spending money in the future, equivalent to, and I've always felt it to be painful to have money leave my bank account in the current time. So because of that, I've always favored saving for the long term. When I graduated from college, though, in 2004, I had the foundations of personal finance built into me, but I knew zero about the world of investing and having your money work for you. And I say that as someone that graduated with a degree in business. I graduated with a degree in business, and I was taught next to nothing about the stock market or growing your money or inflation or so many of the basics about investing. But when I graduated in 2004, my dad handed me a copy of a very popular book at the time called Rich Dad, Poor Dad by Robert Kiyosaki. And I just devoured that book in a period of 72 hours. It was the first time that I'd ever heard of the concepts about the rich. You can become rich in one generation. The rich use their money to grow their wealth. Your house is not an asset, it's a liability. And all these really basic concepts, but they were brand new to me. And that kick-started a love affair that continues to this day with me trying to enhance my financial knowledge as best I can.
Brian, I have so many follow-up questions. So first of all, saving. I think it's a great blessing that you grew up with that, and I can relate to that. Somehow for me, saving always came easy, but I know it's not the case for everybody. I had a wonderful conversation with Brad Barrett that I think you know about being a natural saver or a natural spender and how we can all fine-tune it and overcome it. Now, I'm curious about the point when you got interested in the market. And I've had interesting conversations with a lot of guests on my podcast, how the time you get intrigued by the market, whether it's a bull market or a bear market, really influences how you feel about investing. And I can tell reading your book that you've been shaped in a certain way, but I want to hear it from you. The time you joined the market, was it easy? Was it hard? Did you lose money on the first investments? What was it like?
Yeah. So again, the book that really introduced me to the concept of investing was Rich Dad Poor Dad. And if you read that book, he is a big fan of using leverage. He recommends gold. He recommends penny stocks, right? He recommends all these things that now I just personally am directly opposed to. But I am very thankful for that book for introducing me to the concept of investing. But I would not recommend that book for actually investing ideas. So one of the first asset classes that I learned about was real estate. You know, buying properties and renting them out and having the renters essentially pay your mortgage off. Fortunately or unfortunately, depending how you look at it, I was getting interested in investing in 2004, 2005, and 2006, which was pretty much the peak of the real estate bubble during that time period that led to the 2008 financial crisis. So when I was looking around trying to shop for properties, first off, I didn't have a lot of money, so I would have to like, you know, put 1% down on a property and borrow 99%, which you could do at the time. Believe it or not, that's how crazy credit was at the time. But because asset prices were so high, the numbers just barely were. I mean, just barely worked. And like everything had to go perfectly for the house to pay off. And thankfully, when I floated the ideas to my parents, they basically said, Brian, do you want to be a landlord? Brian, do you want to talk with people about collecting their money? Brian, do you want to deal with tenant problems? And as I thought about it, I was just like, no. Real estate makes sense on paper, but it's just not the right asset class for my personality. So that led me to look at investing in the stock market. And again, my education at the time was zero. I had very little education about what the stock market was. I couldn't tell you anything about how to research a company, how to read a financial statement, what an SEC filing was. So I thought the way that you invested in the stock market was by buying penny stocks. Like penny
Right.
stocks were essentially the meme stocks of the day. People would talk about them on Yahoo's discussion boards, and you would see their prices fluctuate. And I thought the way that you invest in the stock market was you buy something for $1 per share, and then you sell it for $1.20 per share. And why did it go up? I had no clue. I thought it was essentially gambling. So my first introduction to the stock market was buying garbage companies, just absolute garbage companies. And thankfully, I lost money. It was only a few $100s, but man, was that a lot of money to me at the time. And wow, was that a painful lesson to learn. So what was happening in the overall stock market, I was basically unaware of when I first started because I was focused on these garbage companies and essentially trading them. Now, I quickly lost money and I tried a couple of different strategies in there. But once I kind of wised up, started learning from David and Tom Gardner, Warren Buffett, Peter Lynch, I focused on higher quality companies. And that was pretty much 2008. So the investments that I made in these higher quality companies, I mean, you could have, no matter what you bought in 2008, you lost money like immediately. And it was extremely painful to invest that way. However, I was convinced at the time that the stock market was the asset class for me. I was investing for the long term. I was saving a high portion of my income, and we had no kids at the time. So my wife and I continually plowed money into the market, and I was buying great companies at better and better prices. And I still hold some of those companies to this day, including Google. Which has worked out pretty darn well. But my introduction to the stock market, you couldn't have had a quote unquote worse start to my introduction. But looking back, it was a wonderful introduction to the stock market because I lost money immediately and I learned a lot of lessons the hard way.
I really like that. When I give talks about investing, I ask people, have you lost money on your first investment or not? And it really sets a different tone for the conversation and different expectations going forward. If it's too easy the first few times around, I think you can have a wrong idea of what the stock market can do. Which leads me to a quote from your book that I really like. You say that the stock market is the greatest wealth creation machine of all time. And I couldn't agree more, but tell me more about that.
If you look back at any chart that shows the long-term history of the Dow Jones Industrial Average, or better yet, the S&P 500, the undeniable long-term trend could not be clearer: up and to the right. It is not a straight line. It is a rocky road. A whole bunch of volatility happens along the way, but the historic returns for the S&P 500 over centuries has been about a 10% compounded rate per year. And the stock market is the simplest way for ordinary people with ordinary incomes to grow their wealth exponentially over time and retire as a multimillionaire. I mean, thanks to the invention of index funds, automated investing, and tax advantage vehicles such as 401ks and IRAs in the United States, it's never been easier than it is today to harness the power, the long-term wealth creation potential of the stock market. Now, there are ways that you can grow your wealth faster, but if you're looking for easy, no research, compounding growth, to me, there's no better vehicle than the stock market.
I like the idea that the stock market can be what you want it to be. If you want it to be a casino, it can be a casino, but it can be what you call it, which is a wealth creation machine. We manage family fortunes, multi-generational wealth, and the money has been with the families for a long period of time. And I've been responsible for them with my partners for 20 years, my senior partner for almost 50 years. And I've seen a remarkable growth in wealth only because, or mostly because, of the participation in the success of all the businesses which happen to be listed on the stock exchange, which tend to be bigger, tend to be more established. But when you think of the stock market as a place where you get to buy small or not so small pieces of businesses, and it's a place that's open to everybody, as you said. You can start with a small amount and you can put your family fortune in the stock market in a certain responsible way as well. So it's a wide range. And the stock market doesn't care if you're young, if you're old, if you have $100 or $1 billion. It's available to everybody if you use it the right way. I want to ask you about money. And money remains a taboo. It's a controversial topic. It's emotional. It's uncomfortable. But then in your book, you say that money affects us all. Money determines where you live, the food you eat, the education that your children receive, the healthcare you can access, the life experiences you can have, and much, much more. Tell me more. How do we talk about money?
There's really two broad categories that it doesn't matter who you are, you have to know about them. The first would be health, and there's lots of ways to slice up health. That could be physical health, emotional health, relationship health, etc. And the second area the category that just affects every aspect of your life is money. Money is the currency that we use to buy the necessities in our life, to pay for life experiences that we have, to pass wealth from one person to the next. It's an incredibly important topic to understand, and it impacts every area of your life. When I was growing up, money was most certainly a relatively taboo subject in my household. We never sat down and talked about how much money my parents had or how much money they made. In fact, one time I got a look at my dad's tax return, and it had how much income they have. And the next thing he said out of his mouth was, "Don't talk about this with your friends." So I got the impression very early on that money was a taboo subject that should not be discussed. And for whatever reason, that idea is just woven into American society. Not in every family, but it is a broad thing that many people don't talk about money and their finances with others. I still have some aversion to talking about my personal finances with the general public on podcast appearances on this, because that's that's my family finances. So that's me airing our financial information that includes my wife, and she's not okay with that, which I have to respect. But one thing that I have done is tried to make money a less taboo subject in my own household. My kids are aware of what we've paid for our house, what the houses in our neighborhood are worth. My kids are aware of the price that we've paid for our cars, and the luxuries that we have in our life. My kids are aware of the cost of vacations that we go on, as well as the amount that we spend monthly, weekly on groceries and utilities and water bills. So I'm trying to be open and honest with them about what it costs to live with the lifestyle that we have. And I'm trying to make money a less taboo subject with my own children than it was for me growing up. But there's no doubt that, broadly speaking, money is still largely seen as something that you don't talk about.
What I'm hearing is that the behaviors that you observed at home and then the behaviors you want to show to your kids, to your family, are the best way, or one of the ways, to communicate how you really feel about money, even without mentioning actual amounts or net worth or your income, but just the behaviors around how you treat money that's coming in and the money that's leaving your home. I think it's a very interesting way of looking at it. I want to ask you about value and price, and it's a bigger discussion when it comes to stocks, and it's not that intuitive. When people look at the stock market, they look at the prices moving up and down. You mentioned penny stocks, but all the stocks move up and down every day. But you have a whole chapter about the value. So tell me more, what gives stocks value? How do we think of stocks the right way?
Before we talk about that, let's back up and just answer a very simple question, but one that's often overlooked. What is a stock? Like, I think that a lot of people have heard the term stock and stock market but they don't understand what a stock is. A stock simply represents fractional ownership of a corporation. Let's say that again. Fractional ownership of a corporation. Most people are familiar with the concept of a deed to a house. If you would ask who owns that house on there, well, there's a record somewhere of a deed, and the deed says this property and this house is owned by this person. So the deed represents ownership of that house. A stock is the exact same thing, but for corporations, with one important difference. On a deed, you typically have one owner or maybe two, but corporations can be split into like almost an infinite number of owners. So there could be one owner of a corporation, there could be two, there could be 10, there could be 10,000, there could be a billion owners of an individual corporation. So all the stock is a stock represents a portion, a fractional ownership of a business. So why does fractional ownership of a business have value? The answer is that underlying business itself has value. And why are businesses worth anything at all? Well, businesses own assets and they also have liabilities. The difference between the value of the assets they own and the liabilities that they have represents the business's net worth. And if that number is positive, then that business has some underlying value to it. And if you have a stock in that company that has a net worth, if you will, you have a legal claim on a portion of that company's net worth, and that gives that stock value. So that's one way that stocks are valued. Another way that stocks are valued is based on the cash generation ability or the profitability of that company. Let's say there was a company out there that made $1 million in profits per year, $1 million in profits per year, and that company had 1,000 individual shares. Well, each individual share would have a legal claim on $1,000 of that company's profitability. So if there's $1 million in profits divided by 1,000 shares outstanding, that gives each individual share a claim on $1,000 in profit. And if I was to ask you, if I had a legal claim that put $1,000 into your bank account each and every year, would that have value? Would that be something that you would want? The answer, I hope, would be yes. I want to own things that put money into my bank account every year. So that is how you would value a business. Now, we could argue about, is that legal claim worth $10,000? Is it worth $50,000? Is it worth $100,000? But I think we both agree that having a legal claim on a continuous stream of profits or cash flow has some value to it. So that is why stocks, the underlying thing, have value to them.
There's so many wonderful things that you just said. But first of all, I have to share with you something I shared on the podcast before, that the first book I picked up about investing was One Up on Wall Street by Peter Lynch. And as you, I was studying economics, finance, political science, and I wasn't really sure where I'm going to take it. And my professors got burned in the internet bubble, and they hated the stock market, to be polite here. And they told me it's a casino and you don't have to know much more about it. And I picked up this book, and Peter Lynch said that stocks are small pieces of businesses. And somehow that simple idea really spoke to me. And I imagined myself as an owner of a collection of businesses. I could have 5, 10, 20, 50 businesses, or I could own the whole index, whichever way I want to go, the same way anybody else with billions of dollars. And I got much more intrigued about the businesses behind the ticker. What is it that they do? How do they do it? How come they have a profit? You mentioned profits, but what is so special about them? Is it the size, the network effect, the branding, or whatever else that comes with it that would allow those companies to have a profit? But it opened my eyes to a whole new world that I never really thought existed. So that's a beautiful way of looking at it. I want to highlight the profits part, because when people look at the stock market, there are a lot of businesses that have no profits. Mm-hmm. And the last few years, I think one of the major investment banks was following an index that was called a profitless index of companies without any profit. And I think it's okay if an earlier company has no profits, because they're still trying to figure out their business model and unit economics and so on. But if you have companies that have been around for 5, 10 years, and sometimes they say that they don't have a path to profit in the foreseeable future. And I won't quote which company actually said it in their filing. You might guess which one it was. And it's very confusing when you look from the outside, because a stock price of one company that's been around for 100 years and a company that's been around for 5 years with no profits looks to the outside person the same. Can you talk about that? Like, at the end of the day, a business has to generate a profit. If it doesn't have a profit, in my mind, it's not a business if it has no path to profit. Can you talk about that idea a little bit more?
Yeah, well, I actually have firsthand experience with this one, but I'm happy to talk about it in general terms. Now, to answer your last question, we talked about a very simple concept, which was a company that produces $1 million in profits every year. Those profits are owned by the shareholders, and that's why the shares have value to them. That's assuming that profit number, that $1 million per year, is a static figure. If instead that same company produced $1 million in profit in year 1, $2 million in profit in year 2, $4 million in profit in year 3, $8 million in profit in year 4, 16, 32, 64, 128. Essentially, the company's profits were doubling or expected to double every single year. Would that affect the value that you place on that economic claim? Well, it sure would, because with just waiting a little bit more, you're promised with this particular asset to double the amount of income or profits that gets placed into your bank account every year. And if you take off into perpetuity, you'd become the richest person in the world if that just happened like 30 times or so, if profits just doubled 30 times or so. So the perception in your mind is that this is going to be worth much more in the future, because the profits of the company are expected to rise exponentially. In fact, you might be so excited about the prospect of investing in that company today that you're willing to pay 100 times profits, or 500 times profits, or 1,000 times the company's current profits, because you believe the profits are expected to rise so much. Now, if you take that one step further and say, okay, well, instead of this business generating $1 million in profits today, it's going to lose $1 million in profits today, but we still promise that the future profitability of the company is going to grow. So this year, the company's going to lose $1 million. Next year, it's going to make zero. After that, it's going to make $1 million. And then the profits are going to grow exponentially. Would that still be something that you were interested in paying for? Well, again, if the prospect of ever-growing profits in the future is still to be a high likelihood in your mind, you'd still be very willing to pay a premium to own that business today, even if the company is not generating profits. That's why so many profitless companies that are publicly traded, in some cases, garner very high valuations. It's not for what the company is doing today from a profitability perspective. It's what the company expects to produce in profits 3, 5, 10, 20 years from now. Now, that's a concept that's very hard to understand. When I first graduated from college, I was working for a venture-backed medical device startup company. This was pre-FDA approval. So our revenue was zero. We didn't even have a product on the market yet. But we were hiring engineers and sales and marketing people and executives to build the value of the company and to grow a stream of revenue and profits over time. Now, eventually, we launched the product and we started to have some revenue coming in, but our costs were dramatically higher than the revenue that we were pulling in from the product. So we went public and we were reporting earnings to investors, and every single earnings report that we produced had like a $10 or $15 million loss to it. And yet our stock, the value of our company, went up over time. And I was incredibly confused. I was like, how can we lose money, and investors are excited to own the business? I didn't understand it. What I missed was that investors weren't valuing us on what we were doing today. They were valuing us on the future potential of the product that we were building. And by the way, the company that I previously worked for was started in the year 2000. And it didn't make a profit for the first time until 2021. 21 years of losing money in the market before it made a profit for the first time. And the profit that it made was minuscule, a couple of $1 million. And hundreds of millions, if not $1 billion, had been invested into the company at that point. However, if you look today, that same company is currently worth $11 billion. $11 billion in market cap today. So that is an example of a company that lost money for 20 years. And yet, because investors believed in the future profitability of the company so much, they did incredibly well by buying and holding that business.
You're touching on something interesting, which is what drives prices. And that's the belief in what the company can deliver, or excitement that comes and goes, and fear and greed. There are many ways to call it. The trouble is that you have to be fairly correct about the future. And it's a wide range of situations, all the way from a well-established company, let's say Coca-Cola, that's growing at a steady rate. It's not that surprising what they will grow at in the next year or two. And their profitability is fairly stable year after year, all the way to a company that you mentioned that's still proving itself, doesn't have a profit. It's at a different point. But as an investor, you have to figure out where it could be over the next few years. And the more accurate your expectations are, assumptions are, the more successful you will be. I'm curious about the fact that, and you see it as I do, that investors go through fear and greed back and forth. There are moments when it takes only 1 or 2 quarters of missed earnings, even if it's a well-established good company, and the stock price can be down 10, 20, sometimes 30%. And then you see the opposite. The losses are deeper than they've ever been, but somehow the story sounds more convincing than ever, and the stock triples. How do you navigate that as an investor?
Yeah, Morgan Housel had a great quote about how businesses are valued, and the quote was, "Valuation is essentially," and I'm paraphrasing here, "valuation is essentially the numbers from today times the story about tomorrow."
It's
right?
true.
And it's really the story about tomorrow that drives the value and the price of any business. Case in point that I think most investors are familiar with. Think about Facebook's stock
Mhm.
over the last 3 years. 2020 hit, and like every stock that's out there, Facebook stock nosedived when COVID was raging. There was so much uncertainty in the world that everything was selling off right when COVID started. Immediately after that, so we saw the fastest bear market in history, and Facebook stock plunged. Immediately after that, we saw the fastest stock market recovery in history because so many people were trapped at home. They were getting free money from the government. And with plenty of time on their hands, a lot of people said, I'm going to give this investing thing a try for the first time. And in 2020, we saw companies' values absolutely skyrocket. In fact, the lesson that people learned in 2020, unfortunately, was every stock goes up. And the riskier the stock, the faster it goes up. So we saw Facebook stock plunge from COVID and then skyrocket given the frenzy of investing, enthusiasm for investing all the way through 2021. Then in 2022, the story about Facebook changed dramatically. The story became they're spending money like crazy on the metaverse, right? People were very interested in the metaverse in 2021, couldn't care less about it in 2022. We also heard the story of advertising is slowing down. And most importantly, we heard the story that TikTok is going to come in and steal Facebook's profits. So the story that investors believed about Facebook got punched in the face in 2022, and Facebook stock declined sharply. I think peak to trough, it was down like 70% for one of the most profitable businesses in the world. That is because the story about the future of the business is what drives the value of market prices. And then in 2023, what happened? We saw the story about Facebook take a complete reversal. We saw Zuckerberg pull back on spending about the metaverse. We saw growth return to the company, and investors' fears about Facebook being taken over by TikTok were completely neutralized. And we saw Facebook's stock value more than double this year. So Facebook, the company, if you just looked at revenue and profits, they have been fairly consistently going up and to the right. There's been speed bumps, but the actual business of Facebook has been fairly predictable over that 3-year time period. But what the market story that investors have about Facebook gyrated wildly. It became the story is this company's going down in early 2020, and then it became this company is great in 2020, 2021. Shares jumped up. Then it became this business is going nowhere. They're wasting money, and the share price declined. And then that became all reversed in 2023. So the volatility that investors have had to endure from holding Facebook stock has been far more exaggerated than the volatility of the revenue and profits that Facebook has generated. Now, that's a bit of a more extreme example, but it highlights the point that there can be a wide disconnection between what the value of a company does and what the underlying economics of a business do. And the only way that I know of to neutralize that effect is to focus all of my attention on the underlying business of the company and just know that in the short term, stock prices can visit very interesting places along the way. And if you're going to invest in individual stocks, you must be okay with accepting that volatility that goes along with investing, because that is not a bug of the stock market. That is a feature of the stock market.
I like what I'm hearing. So at Seacard Associates, we consider ourselves contrarians, and we try to take advantage of what you just described. I think anybody that invests the time, they can figure out the better quality businesses out there to invest in that they like, that resonate with them. And you can end up with a list of 50 or 100. We have a running list of companies that we'd like to own. But at any given time, the price that we would have to pay is higher than we're comfortable with. And there are moments that you beautifully described when, for some reason, the market is very short-term focused on something negative. and you can have some incredible businesses available half off or less. And obviously, March of 2020 was an extreme when it was such an uncertain time on so many levels that we were stuck at home and we couldn't go to our offices and our work. And I think it affected the investor sentiment more than any other crisis that I can recall, because it was a very visceral experience at the time. But there are moments when individual stocks go for ups and downs that you described with Facebook, and it happens more often than you would think. I sometimes talk about the idea of looking at the last 52 weeks and see the range of any company you like. And people are so surprised that even companies that they think they know, they trade in a pretty wide range in the last 52 weeks. And I'm always intrigued, how could I benefit from the low of that range, or a 5-year range or a 10-year range? And there are moments when somehow the market falls out of love with the company. I want to ask you about the quality and overpaying for stocks, because I think it's a dangerous territory for a lot of people. People fall in love with the story that you describe, and they think that any price they pay is fine. It doesn't matter how much you pay. So paying too much for a great business is not a recipe for success. Can you talk about that? I find it really intriguing, and I think it's not that intuitive to a lot of people.
Valuing a business and learning how to value a business the right way is one of the most challenging aspects of an investment, because it's almost like two things can be true at the same time. First off, no business is worth infinity dollars. The greatest businesses in the history of mankind, even if it's Apple, which seems to be one of the greatest businesses ever at all times, Apple is not worth infinity billion dollars, right? It's worth a couple of trillion dollars currently, which is an insane amount of money, which is just a ridiculous amount of money. But if you pay too high of a price for Apple, especially today, the odds of you earning a positive return moving forward are diminished greatly if you overpay for a business. That's one truth about valuing a business. Another truth that I had to learn the hard way about a business is the higher the quality of the business and the longer the duration of that company's growth cycle and competitive advantage phase, the more you should be willing to pay a premium to own that business today. So higher quality businesses that can generate high returns on capital for long periods of time deserve to trade at a higher valuation today than an ordinary business does, or a low quality business does. However, just like the fact that companies are not worth an infinite price, there is an upper limit to that number. Microsoft is undoubtedly one of the greatest businesses of all time. However, if you were buying Microsoft stock in 2000 at 50 or 60 times earnings, even though Microsoft eventually delivered on the growth of that, you had to wait 16 years before you got back to even on your purchase of Microsoft, because the valuation over the next 16 years went nowhere but down. So even though the business continued to grow, the speculative portion of the turn just zapped all of your returns away from you. So in general, when it comes to valuation, investors should do their best to buy higher than average quality businesses at lower than average prices. And if you can consistently do that, the odds of you making money dramatically improve over time. However, that's very easy to think about conceptually. It's really hard to actually execute on that strategy, especially in real time.
No, that's brilliant. I'm thinking about the idea of growing into your valuations, which you mentioned with Microsoft and many other companies that reach a certain peak in terms of valuations, and then they actually have to grow into those bigger shoes that they're supposed to wear, and that may take a decade. And you would have to be a really patient investor to stay with the story and with the company long enough to see the benefit in the long run. I want to ask you about the daily price movement. You have a little story in your book that really resonated with me and made me smile. You talk about pumpkin spice latte and salted caramel frappuccino announcement that Starbucks did a few years back, that they will release those flavors ahead of time, their fall flavors. And the price moved on that day. and made me smile because I've seen it so many times when the stock price moves on very short-lived small news, but creates a momentary excitement. It's very confusing for a less seasoned investor. What is it that's actually happening? And part of me would want to know that that Starbucks will announce those flavors earlier ahead of time. But when you really think about it, it's just a cute story that may not have a bigger bearing on the long-term success of the business.
Yeah, let's get back to that Morgan Housel quote for a second. The value of a business is the numbers from today times the story about tomorrow. The numbers from today are accessible to everybody. All the time. There's no edge in just looking at the numbers from today. So that, and the numbers from today don't really change all that much or all that drastically from quarter to quarter or from year to year. They can, but generally speaking, the numbers from today have a relatively predictable trajectory ahead of them. The thing that is unpredictable about the stock market is the story about tomorrow. How investors are going to feel, literally feel, about a business changes from minute to minute, moment to moment, and day to day. So if investors feel more excited, more bullish on Starbucks today than they did yesterday, then shares of Starbucks are going to rise. The enthusiasm for becoming a shareholder of Starbucks, if that increases, so too does the price of Starbucks stock. And the inverse is also true. So yeah, in my book, I highlight a very simple case where Starbucks announced that it was launching its spiced latte and salted caramel frappuccinos. It was bringing those to market earlier than it had been the year before. So in some investors' minds, or I would actually say in some traders' minds, that created slightly more optimism that the near-term profitability of Starbucks would rise at a faster rate than was previously expected thanks to that small change. And in turn, that means that shares of Starbucks today are worth, in traders' minds, slightly more than they were in the previous day's trading session. So that's why shares rose on that particular day. And the next obvious question becomes, well, how can I take advantage of that? How can I predict when enthusiasm for those stocks or bearishness on those stocks will happen? And how can I take advantage of that? That is a game that I don't even think is worth attempting to play, because what you're trying to do when you're trading stocks is what you're trying to predict the collective mood of all market participants will be in the near-term future. Now, I don't know about you. I can't predict what mood I will be in 4 hours from now, based on what's going to happen with the rest of my day. Are good things going to happen and I'm going to be in a happier mood than average 4 hours from now? Or am I going to get a call that one of my kids is sick or something's going wrong in my household and that will cause me to be in a bad mood 4 hours from now? I don't know. I can't predict what my near-term emotions will be. So if I can't predict my emotions, what chance do I have of correctly predicting the emotions of investors collectively? I don't think that I can do that successfully. So if I can't anticipate the emotions of investors, how could I possibly predict what stock prices are going to be 1 hour from now, 1 day from now, 1 week from now? So that's why I think that's an important concept to understand, because once you truly understand that, you realize how foolish it is to try and trade stocks.
No, I think it's brilliant. I like the idea of focusing on long shelf life ideas. And it might have been Nick Sleep that brought up the idea initially. When you get a piece of news, and we have interns now and then, I ask them, is it good or bad as a buyer of stocks for you in this particular moment? And then, do you think this piece of news will be relevant 3-5 years from now? And as cute as the story of the spiced latte is, we will forget about it. We'll use it as a case study to amuse ourselves, but it's not what's going to move the fundamentals of a business over the long run. And paying attention to that, as you highlighted earlier, pays more in the long run, especially if you want to be an investor and a business owner for many years to come. So as much as it's amusing to see those headlines that move the stock price in a day, that's not where the real money is made. I want to ask you about recessions. And you make a point in your book how every time the market recovers from recessions, and I think recessions are a scary moment, and market crashes in general. How do you think about that? And why does the market always recover? What are your thoughts?
Yeah, when I was brand new to investing in the stock market, I'd been shown that long-term chart of the S&P 500, just like many people have seen. And again, the undeniable long-term trend is up and to the right. And it was told to me by the books that I was reading that yes, markets occasionally crash, but I was told that historically they've always recovered from crashes and they always go on to set new highs. And that never made any sense to me at all. That was I'm a fan of the phrase, or I've heard the phrase, what goes up must come down. And the stock market seemed to defy that convention. And while what goes up must always continue going up is essentially the what's happening with the stock market. Again, just never made sense to me at all. Now, if you look back at the major crashes or stock market declines that have happened over the last 100 years, all of them can be relatively understood by the general public, right? We saw the 1929 stock market crash, which was kicked off the Great Depression. Given the Great Depression, it's understandable why stock prices declined. We saw a big decline in the 1940s caused by World War II. Makes total sense. We saw the stock market decline in the 1970s caused by the oil crisis and Watergate. Again, makes sense. We saw the dot-com crash. Makes sense. We saw the 2008 crisis. Makes sense. We saw COVID 2020. In each case, there was something bad going on at the macro level that made sense to me why stock prices would crash in those cases. What never made sense to me was why the markets had always recovered. Why did the markets recover from crashes? So I think if you can understand the reasons why stock prices recover, it will tremendously help you to hold and maybe even buy more during scary times. So broadly speaking, there's a couple of reasons why investors should expect the stock market to recover. Number one, tough times, bad economic times, force businesses to become innovative and to change their ways. When times are going well, you don't have an economic forcing function to adopt new strategies or try new things or make changes to your life on a consumer level to save money. When times are good, we live happily. It's only when crises are happening and things are going horrifically wrong that businesses are forced to change their ways, to try and save money, and to launch new innovative things to market. In fact, during periods of economic crisis, innovation accelerates.
That's
innovation goes up. In addition, during bad times, good companies survive, and bad businesses, the weakest businesses, die. They cease to exist. Well, when bad businesses die, that leaves more customers for the strong companies in their industries to go out and capture. So during bad periods, good companies expand their market share, bad companies lose their market share or die altogether. So bad times are actually good for strong businesses and bad for weak businesses. Second, when bad times happen, the government certainly becomes aware of that. And they take actions through government assistance, through direct payments, as we saw during COVID, or through controlling interest rates to make the business environment easier for companies to operate in. So interest rates tend to decline. That lowers borrowing costs, which makes companies, again, strong companies, the ability to take on projects that may have not made sense when interest rates were a little bit higher. And then lastly, when people are laid off, when employees are laid off during bad times, it forces them to become entrepreneurs. When people are laid off and they're stuck at home and they have trouble finding work, many of them will actually develop innovations and start businesses from scratch that they would not have started during good times. And that, again, accelerates innovation. And it's really new business formation that often introduces new business models and new technologies to market. So it opens up new market opportunities for businesses to take advantage of. When you combine all those together, eventually the bad businesses die. Eventually the good businesses capture market share, and with government assistance coming in, eventually the economy will reach a bottom, and that kind of lays the foundation for the next bull market to start. And that's when the green shoots, the innovations and the entrepreneurs that were started during the bad times, that's when they really start to grow and take off, which sets the legs for the next bull market to take over.
No, it's very true. I'm thinking that the stock market is not the economy. That's one thing that I think it's very important to remember. And I see investing as a lifelong pursuit, but there are moments when you can buy incredible companies at incredible prices. And these are moments where it's the least comfortable to go in. And these are the times you describe where it's very high uncertainty about the future. The immediate outlook is not so promising, but these are really the times when you can buy the best businesses at prices you haven't seen in a while. And it's very counterintuitive. It's very uncomfortable, and it comes more naturally to some people, less so to the others. But these are the times when you can make the biggest difference, especially if you choose to be a stock picker. But even if you're buying an index, these are the moments where you might choose to allocate a little bit more than usual to the stock market than in times when the valuations are high and it's too good to be true in terms of the market story. I want to ask you about patience. And patience is one of the words that I probably use the most, both in this podcast and in my writing. And you say that, and I love hearing this, that the patience is the biggest edge over Wall Street that we can have. Talk to me about patience.
When as an individual investor, the deck is truly stacked against you in so many ways when it comes to competing against professional investors. You have worse and slower information than professional investors do. You don't have access to management teams or research reports or analyst calls on the same level that they do. You don't have access to faster computers than they do, so they can trade faster than you do. So what possible edge could you have over professional investors or professional traders? It almost seems illogical that you could have an edge over those people. However, you do have an edge, or you could have an edge over them if you choose to. And that edge is really that you have, as an individual investor, the ability to truly invest for the long term and with a long-term mindset. So many people on Wall Street are hyper focused on the story about the company. How is the story about the company changing? How are prices going to change? And how can we position ourselves to take advantage of the changing story about a business? Again, I don't think that's a game that individual investors should even bother with playing. It's too hard, and it's too hard to know if you're doing well. But if you can bet on the long-term economic growth of a business or the long-term profit growth of the economy in general, that is the game where you can actually win. And as an individual investor, you actually have, in addition to time, you have something going for you that money managers, professional money managers, would kill for. You have permanent capital. Permanent capital. When you are managing somebody else's money, and you're making money from somebody else's money, you are taking on a number of risks, or there are so many additional factors that you have to consider when you're making an investment. It's not only, is this a good investment? You have to ask yourself, is this such a good investment that I can convince my clients to stick with me when prices are going the wrong way? And you have such career risk as a money manager that you're constantly having to consider, how will my investors interpret this holding? As an individual investor, you don't have to worry about any of that, right? You are your own client. You are not going to fire yourself because you have a bad month or a bad quarter or even a bad year. Your
Hmm.
capital is your capital to manage, and you don't have to think about career risk or selling your ideas to anybody else except for yourself. That gives you the intellectual freedom to truly focus on the business and truly invest with a long-term mindset, which is something that some clients on Wall Street simply won't allow their money managers to do. So that is your source of your edge as an individual investor, and the only way to take advantage of that is to invest with a long-term mindset and with a huge amount of patience, more patience than the market in general has. And if you can do that, that's how you can win as an individual investor.
No, I love what I'm hearing. I'm thinking of a couple of conversations that I had. I spoke with Guy Spear about managing your money, your family money, and other people's money. It's a very different experience. And the second thing I wanted to mention, the money that we manage for our clients, we say that it's a capital they don't immediately need and a capital they can't afford to lose. And it sets a certain framework to think about investing. But we're trying to get as close as possible to what you would call a permanent capital that you can actually invest and wait 3, 5, 10 years for the story to play out the way you thought it would. Brian, I have one last question for you. I want to ask you about success, your personal, professional definition of success. How do you think about it? How do you know you're on the right track?
Great question. And my personal definition of success has changed over time. When I was growing up, I thought that success would be having a limo, right? Having somebody to drive me around in a limousine. I thought that was like the ultimate definition of success. And then when I was in college, I thought the definition of success was having a big house, a fancy car, and being able to take fancy vacations. The longer I live, though, and the more I become, the more time goes on, the more I realize that the only true definition of success to me, financial success to me, is complete control of your calendar.
Hmm.
That's it. Complete control over your calendar. You can spend your time working on the projects you want, with the people that you want, and under the circumstances that you want, and you can quit those projects at any time without any impact on your family's lifestyle. That is true success and true wealth, in my opinion. So the ultimate financial goal for me is just absolute 100% control over your calendar.
Would you call it freedom?
Absolutely. Yeah. It's just a shorter way of saying that is complete financial freedom.
I love it. Brian, this was brilliant. I learned a lot, and you have a way of presenting very complicated ideas in a way that's very relatable and easier to follow. And I think more people should consider participating in the success that the stock market can offer. And it is, as you said, a wealth creation machine that's open to everyone if you look at it the right way. So I will include everything in the notes so people can follow you and learn more about what you do. But I think you're doing a remarkable job introducing people to a whole new world. So thank you for today.
Thank you, Bogomil. I really enjoyed this conversation. Thanks so much for having me.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogomil Baranowski. The content of this podcast is for general informational purposes only, and so are the opinions of members of Seacard Associates, a registered investment advisor, and guests of the show. This podcast does not constitute a recommendation to buy or sell any specific security or financial instruments, or provide investment advice or service. Past performance is not indicative of future results. More information on Seacard Associates is available in its Form ADV disclosure documents available at advisorinfo.sec.gov.